No, hell no. Okay, anyway, how many times am I going to swear on these? I'll probably get fired now. Have I made fun of students on it yet? Okay. Have I made fun of the president on it yet? Stop me if I start doing that. I'm kidding. He doesn't care if I make fun of him. Okay, anyway, he's a good guy. All right, see, I put that in recorded. Yeah. All right, anyway, yeah. Jay McGowan's the president. Have you guys met him yet? He'll come around and see you sometimes. Very nice guy. You should hear him do Elvis Presley. Sing Elvis Presley. I'm not kidding. Ask him to. If he's at an event that you're at, he's around, ask him to. He's really I'm not kidding. He's very good. So I was shocked. So anyway, okay. So what I want you to do then is write down the beginning, and then we'll figure out the ending too. So I left a little room at the top for the beginning, a room at the bottom for the ending. But we're going to do it for assets, liabilities, and equity, beginning and ending. Revenues and expenses. What's the beginning on revenues and expenses? Zero, of course. So all you need is the ending, of course, right? And that's all I gave you. All right. So I've got contributed capital at 2012 is 100,000. Where should I put that? Beginning or ending? 2012 compared to 2011. Come on, careful, guys. That's the ending, isn't it? So I got 100,000 here. Everybody agree? I just write down what I gave myself here, right? That's that one. Okay, and then at the beginning, what was it? 200. So somehow the bottom fell out on their equity. What do you suppose probably happened? Either huge dividends or lost money, maybe dividends and lost money. Actually, some companies, when they lose money, still pay dividends because they like to pay dividends every year. General Motors does this. Even if they're losing money, they pay dividends because it's supposed to tell their shareholders they're really a stable company after all. I think it's nuts. You lost some of my money, and so now you give me back some? What are you doing, right? Save the company, please, right? But anyway, so companies do. So it's not all that unusual. Anyway, revenues are 240. We can probably put that over here, right? And of course, that's just the current year revenues because it started at 0. Okay, net income or net loss, we don't know. Liabilities, what do we have at the beginning? 270. So we'll put 270 in here. Hey, I think I can solve something now. Okay, and then what do we have for liabilities at the end? 300. So we increased our liabilities and reduced our equity. Not the direction we wanted to go in, is it? Everybody agree? Crazy. All right, so good. And I can solve 2 things now. Dividends are how much? Nothing? So where's dividends going to go? In retained earnings, which is a kind of an account as retained earnings. Category of retained earnings is the category of what? Equity. It's part of equity. Absolutely. That's why I do it under equity, right? Okay. So retained earnings, and then the other type of contributed capital. Yeah. The other type of equity is contributed capital, right, guys? That was a hard question. Okay. Anyway, so what we've got then is dividends are nothing, and dividends would have been what if there had been an amount? What would it have been? Debit or credit to retained earnings? Debit, why? It's not a loss. You didn't lose anything because the owners took out some of the profit. You can call it a loss, but it's a reduction. Go for that. Reduction of retained earnings, right? They took some of the retained earnings out. They didn't retain them. That's what dividend is. Okay, so we got a dividend here, guys. Everybody good? All right, very good. Very good. All right. It happens to be 0, so that'll remind me of 0, I guess. So we did that one, we did that one. Notice I'm taking care of everything. Okay. I skipped one. Retained earnings at the beginning is what? Good idea to put check marks on. What's beginning? 160. So there's the beginning. Everybody agree with that? Okay. Why is it a credit? It's an equity account. Yeah. Okay. Didn't say it was retained deficit. What if it said retained deficit? That's a debit. That means my losses plus my dividends since I started the company is bigger than my net incomes since I started the company. People who go bankrupt end up in this situation. Make sense? They have negative retained earnings, deficit retained earnings, right? Debit balance. And that gets bigger than their contributed capital. Now what do you have? Assets are smaller than liabilities, guys. You're in trouble, right? You're in trouble, okay? All right, anyway, so the ending is how much? 200. What would that imply? They made 40,000. Uh-oh, but then equity went down. contributed capital? Where did I write down the contributed capital? Oh, I wrote it down in the wrong place. Where does contributed capital go? Not up there. Where does contributed capital go, you guys? Sorry. Where should it have gone? No, did anybody notice that? I picked it up now, didn't I? Wait a minute. This is contributed capital, isn't it? So what do you think? Okay. This is contributed capital down here. That's where I should have put what? The 200 at the beginning, right? And 100 at the end. Oh, that's kind of weird. What happened here? They bought back some of the stock from the owners. Ah, so we have income, but then the contributed capital went down because we bought back some of the stock. Oh, okay. So you see what I did wrong, guys? Contributed capital is not total equity. What's total equity? Contributed capital plus retained earnings. How many noticed I did that wrong? Okay, now look, you guys. I told you this already. Was it last time or the time before? When your boss makes a mistake, when your professor makes a mistake, I'm the boss here. This is the best way to be a boss. You guys pay me to be your boss. Okay? Weird. Hopefully you won't continue that throughout your career. Right? Boss will pay you. Okay, anyway. When I make a mistake, what do you need to do? Say so. When your boss makes a mistake, what do you need to do? Say so. With me, you don't have to be particularly diplomatic. You say, oh, we're crying out loud. Right? That's wrong. Fix it. Okay? But with your boss or with other professors, I'd be a little more diplomatic than that. I think maybe that isn't, the way to do that. Okay? But do it. All you guys are sitting there, I'm going to explain to you how to do it wrong, and then you'll all do horrible in the quiz and test. That'll be great. You don't want that, right? So, all right, anyway. So now what can we solve? Did I write down everything? I did, didn't I? What can we solve for? Okay, equity beginning and ending, maybe? How would you get that? 200 here, contributed capital, 160 retained earnings. What's the beginning? 360. You want to do the ending too? Seeing as we got the 100 and the 200, what's it at the end? 300. Good. Now what can you do? Total assets, what was it at the beginning? 270 plus 360 is how much? 630. Everybody agree? What's it at the end? 300 plus 300 is how much? 600. Okay? So we've got the beginning and ending assets, don't we? Right? Which is that answer there, right? And that answer there. So we know those two now, right? There they are. Okay, we got two of them. Now what? We can solve for net income. What must it be? Went up by 40 and you didn't take out any dividends, so net income has to be 40. So now we can put this net income here. Would you guys buy that? Now what can you solve for? How much? 200. Excellent. Yeah.
Is that the beginning expenses or the end expenses? Well, there's not any
The beginning balance in revenue expense accounts is 0 because last year at the end of the year I closed the books and I'm starting over. I can't believe you asked that question. Oh my gosh. Oh, no, that's fine. It's all right. Anyway, I'm just a total failure as a teacher. Don't worry about it. Okay, anyway, so we got it, okay? Now, is there anything else? Oh, yeah, we need one more because we've got the expenses done and we've got the net income done and we want this owner investment here, and how would you get that? Yeah, it's really buying back treasury stock is what that's going to be later. They bought back stock, they must have, right? Because the owner's investment went down, they returned the investment to them. Ah, there you go. I do love to throw in hard things, though. Drive you nuts when you try to do this? Yeah, what could much stuff like can't be right. Okay, anyway. Everybody got it? We good with this problem? Do something else. Let's do something that we don't know how to do, maybe. Well, or maybe not as well. Oh, these are pretty good. I like this. I'll make up a problem instead of using theirs, though. Okay, let's say we wanted to do two things at once here. Three things at once. Let's say we purchased insurance for the next 3 years. Okay? So let me give you a year in of June 30th. That's a fiscal year end, you guys. You can have a year end whenever you want. Fiscal year end, June 30th. Everybody got it? Okay. So I bought a 3-year insurance policy for $3,600, because I like simple math. How much is that a month? 3,600. How much is that a month? 100. Okay. Anyway, 3,600. So $100 a month. Great. And let's say that we bought that. I don't know. February 28th. Everybody got it? 2/28. That's the date we bought it. Okay. I'd like you to give me a journal entry for recording the purchase. In fact, there are 2 different ways to do it, right? But first, well, I'll do it whichever way you guys come up with first. What did you buy it with?
Cash.
So what would you do? Yeah. So you get an opportunity to do stuff like this, I bet. So this was at February 28th when we did this, right? Okay, debit cash and credit what? I'm sorry, credit cash and debit what?
Insurance expense.
You want to do insurance expense? Oh, I hear prepaid too. Which one's right?
We've already used up 4 months or
We haven't used up any on February 28th, but I don't care. You can put it in insurance expense anyway. Because you are going to use up, what, by June 30th? 4 months? March, April, May, June. Be careful. What if that was February 1st? Now you've used up 5 months. So be careful. We'll have problems that say the 1st, the problems that say the last day of the month. It's 1 less month or 1 more month. So is this going to become insurance expense when we use it up? Yes. So is it okay to put it in insurance expense? Yes. Have we used it up yet? No. Is it okay to put it into prepaid insurance? Yes. Either one is fine. They're both right answers. If I don't tell you how they recorded it, you just record it. Yes, sir?
So right now, are we recording as if it was the 28th?
Yeah, this is February 28th. Okay? So debit insurance expense is one way. That's the one I heard first, so we'll do that. So that's a debit, okay? I know they should be in columns. That's debit 3,600, credit cash 3,600. Everybody got it? The alternative would be to debit prepaid insurance, that's fine, and credit cash, right? And you know what? I could give either one of these, I could give either one of these to you guys, right? I could give either one of them to you. But because both are right. So what if I told you that they had recorded it to a nominal or temporary account? Which account would that have been? Insurance expense. What if I told you it was a permanent or real account? Prepaid insurance. Got it? Or I can just tell you they went to the expense account or they went to the asset account. Whatever. Everybody got it? Okay, good. So either one of these had been okay on February 28th, okay? Either one would be just fine. But the adjusting journal entry will be different with those 2, won't it? So let's say what they did was they put it in insurance expense first. What would be your adjusting journal entry? This is one of those adjustments, right? At June 30th when you're going to do financial statements. What do you need to do? What do I have in insurance expense? You can draw a T account and look at it. Might be a good idea. Insurance expense. What do you have in it? Obviously. 3,600. Everybody agree? If that's your only insurance policy, that is relating to this insurance policy, that's what you have in there. Everybody agree? What do I have in prepaid insurance right now? No, I don't. What do I have in prepaid insurance? This is 2 different ways of doing it, right? This is you could do this or you could do this. You're not going to do both. You only pay the check out once. So what do you have in prepaid insurance here? 0, nothing. You didn't put anything in it, right? Those are separate, guys. You could either do this entry or you could do this entry, right? Can't do both. You only pay the cash out once. All I'm saying is it doesn't matter if you have the prepaid insurance or insurance expense. It does not matter. What matters? When you do financial statements, you have the right amount in each of those accounts. And the adjusting journal entry is going to be to get the right amount in the account. So all you have to do is ask yourself, okay, if I know insurance expense has 3,600 in it, ask yourself, what should it be? If I know prepaid insurance has 0 in it, ask yourself, what should it be? Can you do that? Of course. So, and you already did, didn't you? How many months have been used up?
4.
4. How much was it a month?
100.
Not 1,000. Okay, $100 a month, right? Oh, so 4 times 100 is 400. What should be 400? It's the amount you used up. What account represents that? Expense. Insurance expense, whoops, should be 400. How much have you not used up? You know, it's 36 months, you used up 4 months. How much have you not used up? 32 months, and 100 a month is 3,200. Got it. So what should be 3,200? What represents insurance you haven't used up yet? It's prepaid. Got it. It's easy, isn't it? Okay, so can you tell me what the adjusting journal entry is now? This is a joke now, isn't it? I've got 3,600 in account and I wish it was 400. What do you do to it? Credit for 3,200, don't you? Isn't that what you do? Credit insurance expense. Don't be nervous, just let yourself think and you'll figure it out. Nerves do you no good. Okay, what about this? What's the debit going to go to? I got prepaid with nothing in it. I wish it was 3,200. What am I going to do? Debit it for 3,200. If you didn't use it up, you take it out of insurance expense and put it into prepaid insurance at the end of the year. Everybody agree with that? That's what you do, wouldn't you? Everybody agree? What are you going to do next year? Well, maybe not, because I got 3,200 in prepaid insurance now. If I just left it there, what am I going to need to do at the end of the next year? How much will I have used? 12 months, $1,200. What will I do? I'll take 1,200 out of the prepaid. Credit prepaid insurance, 1,200. And what would I debit the next year? Insurance expense for 1,200, because that's how much I used. And that brings the balance down, I don't know, to 2,000. What would I do the year after that? Exactly the same thing, because I use up another 1,200, wouldn't I? Debit insurance expense, credit prepaid, and there'd be 800 left there. When do I use that? In the next 8 months, then I have to buy a new policy. Start over. Yes, sir.
So, I'm a little confused. Do you record what's remaining or what you've used?
Oh, what do you want in expense? What you used. What do you want in prepaid?
Shouldn't that be
What's expense? I only use 400.
I know, but you wrote down 3,200.
Prepaid is 3,200. Expense is 400. I had 3,600 in expense. That was way too much. So I took 3,200 out. I'm reducing the expense by 3,200 because I have 3,200 too much in there. What I care about is this ending balance here. I do whatever I need to do to get to the right ending balance. This represents what I used up. The journal entry doesn't represent what I used up. Insurance expense represents what I used up. Got that?
That's what I think. I think I'm doing it wrong.
Well, you know what? Don't memorize, because on the next one, that's exactly what our entry is going to look like. But that doesn't mean your entry is how much you used up. Your entry is to adjust from where you are to where you want to be.
Okay.
Always. Always. Figure out where you are, figure out where you want to be, and T accounts are real nice for this because you write down where you are and where you want to be, and then you can see the journal entry, right? So you don't have to use a T account, but it's kind of nice. Okay? So now let's try it if you did it the other way. Let's try that. If you had set it up this way, debit prepaid insurance here, right? And credit cash, which is fine, because it was prepaid insurance. It's okay to put in the insurance expense. Why? Because it's going to be insurance expense someday. Please don't put it in land or building or, you know, salaries expense or something. Don't do that, okay? Because then it's hard to find. But if you put it into prepaid insurance or insurance expense, either one's okay. If you have two different bookkeepers and they learned how to do it one way or the other, don't drive them nuts trying to make them do it a different way. It doesn't matter. You don't care how they put it recorded. All right? You just adjust to where you need to be at the end of the period. It's all right. Okay. Anyway, so let's do the adjusting journal entry if they had recorded it this way. So it's June 30th, right? That's our year end. Always look for what that year end is, okay, guys? Always look for the year end. If it's not December 31st, it's not, right? Company doesn't have to use December 31st. Most companies try not to, especially if you're real busy at the end of the year, at the end of the calendar year, December 31st. You don't want to close your books then and do your financial statements. You want to do that when you have a lull season. So if I was selling Christmas stuff, I certainly wouldn't have a December 31st year end. Although if I'm a farmer and I'm really busy in the middle of the year, I might use December 31st or November 30th or something. You got the idea? Right? So you do it when you're not real busy. Also, there are tax benefits a lot of times of having a different year end than the calendar year for small businesses. Okay, you'll learn that in tax classes. Okay, learn about it. So let's do this adjusting journal entry. Again, let's do T accounts, guys. They're real handy. Let's do insurance expense. What does it have in it now if we did it this way? No, careful. What does it have in it if we did it this way? 0. I didn't put anything in there. Prepaid insurance, what do I have in it? That would have the whole 3,600 now. Oh. And we already calculated what we want insurance expense to be. What do we want it to be? 400. Sure, 4 months went by. Right, guys? What do you want to have in prepaid insurance? 3,200. Everybody got it? Yeah. Oh, gee, it's 0. I wish it was 400. What do I want to do? What do you want to debit insurance expense for? 400. Stay in it, guys. Okay. Insurance expense. 400. And what do you want to credit prepaid insurance for, of course? If I used up 400 of it, I better take it out of there, right? Okay. Take it out of prepaid insurance because it's used up. Are we good? And then next year you do take 1,200 out, the year after 1,200 out, the last year you have 800 left, take it out. Right? Debit insurance expense, credit prepaid. Did you do this? Could you do it if it was rent expense instead, prepaid rent instead, insurance? Did you do it with the interest? Did you do it with, I guess, salary? Kind of weird, 3-year salary. Did you do it with any expense account? Any prepaid? Okay, I want to do another thing with this stuff now that we've got it. Okay, let's assume that we're making this journal entry. Debit, prepaid insurance, and credit insurance expense for 3,200, okay? Let's assume that we're doing that one. So our adjusting journal entry is debit, prepaid expense. It's 3,200, was it? Amazing memory, huh? Credit insurance expense. Some of the other questions, I gave you stuff like this or I gave them stuff like this on the quiz, didn't I? And you have a whole bunch of homework problems that are like this. Adjusting the accounts, right? Doing adjustments. So practice a bunch of them. Okay. You can adjust anything from where it is to where you want it to be. Sometimes you have to figure out where you want it to be. It's a hard thing. Okay, let's do this. What if I fail to record this? What's the effect on the balance sheet and the income statement if I fail to record this? Well, first I think what I do, and I ask questions like this too, the first thing I do is figure out what happens if I do record it. And then I figure out what would be the effect of not recording it, huh? You know what the impact is on assets, liabilities, equity, revenue, or expense, or you couldn't have done the journal entry, right? Do you guys know prepaid insurance is an asset? Yes. Do you know insurance expense is an expense? Yes. You know it, don't you? You know both of them. Okay. So, prepaid expense, debiting that prepaid expense, prepaid insurance, right? It's a type of expense. I guess I should say insurance, that's what we said before. Sometimes they call them prepaid expenses, but more often prepaid whatever it is. Prepaid insurance. It is a prepaid expense, of course. Prepaid expense is an asset, right? It's like unearned revenue is a liability. Right? Good. Okay. Some of you guys look worried. Stop it. Stop it. If you're working hard, you don't need to be worried. Nothing to worry about. If you work harder than your competition does, everybody's as smart as everybody else. I don't believe in that nonsense about smart and stuff. That's crazy. It's hard work. If you work harder than everybody else, guess what? You're going to get more done. Not every single time. Sometimes just do something. But almost always. Almost always. It just happens. It just happens. Okay? So just relax and keep working. Okay? All right. Don't relax so much you don't work. So what would be the impact of this journal entry if we did it? What would happen? What does debit prepaid insurance do? What do you think? Increase assets. How much? 3,200. Right. What else does it do? That's that. What else does it do? Decreases expenses. How much? 3,200. What does it do to liabilities? There's no liability in the journal entry. What does it do to liabilities? Nothing. You'd say no effect, right? Oh, man. So what must it have done to equity? Let's see. Assets went up by 3,200. Liabilities didn't change. What do you think?
Equity goes up.
It goes up by 3,200. It just does. It has to, right, guys? This is too easy to believe, isn't it? Okay? What happens to revenue if you don't debit or credit revenue? Nothing. No effect. Well, gee whiz, I lowered expenses. What did I do to net income? Raised it. You knew this or you couldn't do the journal entry, you guys. So don't miss it on a quiz. What does that increase in net income do to your wealth, your equity? Increases it. That's how you got the 3,200 increase. You could get an increase in equity by debiting cash and crediting contributing capital. You could get a decrease in equity by debiting retained earnings and crediting cash when you pay a dividend. You couldn't, right? So you get it directly. How do you get it indirectly? By changing revenues or expenses. Did you change net income, right? That changes retained earnings too. Getting your head around this stuff? Seeing the model? Seeing the picture? Have I got every single person in the room to quit trying to remember things? Trying to figure things out? Am I getting there? That's my biggest job in the first course. If I get you to stop memorizing and start understanding, we got an 8. And then, you know, when you graduate with a 3.8, 3.7, 3.6, I want you to send me a thank you note for stopping you from memorizing stuff. It's not going to work anyway. It's not going to work. Okay? There's too much. We have computers for that. Memories aren't particularly valuable. Sorry. Associative memory is good. Somebody starts talking about something, you know, a whole bunch comes back to you. That's what it is. It's just recall. And you know, I don't get any tests. Nobody gives me a test. When I worked in public accounting, nobody gave me a test. Could you remember this and write it down for me? What a joke. I can't do that. Okay? Let's figure things out. Okay, anyway, so everybody good? Now let's change it to a different problem. Instead of asking, you know, what's the impact of that, what would happen if we failed to do it? If you fail to make this entry. Now here, guys, I am not going to give you the entry. You're going to come up with the entry, right? I am not going to tell you what the effect of the entry is that we just did there. You're going to do that. But once you have, you can answer the question. And all the question will be is, what happens if you don't record this? Okay, you tell me. If this journal entry would increase assets by 3,200, what's wrong with them if you fail to do it? Yeah, how would you say it? Understated. This is understated. That's it. You have less assets than you should on your balance sheet. Understated. Right? How about liabilities if nothing's wrong with them? Nothing's wrong with them. How about if equity, it should be higher? No, it should be higher. That arrow's going up, it would increase it. So what's wrong with it now? If this side's understated, guess what this side is? Understated. It's got to be the same on both sides, right? Everybody agree? Okay. If revenues are okay, aren't they okay? Yeah. If expenses should be lower, what's wrong with them? Overstated. And an overstatement of expense would do what to net income? Too much expense, too little net income. Net income is understated, which is what causes that understatement. Everybody got it? It's not hard if you think through it and think through it. How many journal entries have you done so far? Doing the homework and in here, on the quizzes, a bunch of them. You could take any one of those journal entries, ask yourself, what does it do to the accounting equation? To the assets, liabilities, equity, revenues, expenses, right? The balance sheet, income statement. What does it do? And then you could ask yourself, what does it do if I don't record it? And you'll get all the points on this. You'll see this on the quiz, you'll see it on the test, you'll see it on the final. I love these things, right? Okay, and they're easy if what? You know the journal entry, you know what it does, okay? Also, it tests on whether or not you do the journal entry, right? They get that. And you got to know what the journal entry is doing with the statements, right? And then you figure out, well, what's wrong? I didn't do it, okay? We do this stuff all the time in real life, you guys. Okay, let me give you another one, and I want you guys to do it now instead of me. So take a piece of paper and do this. I sold inventory, that's a B, inventory that cost $400, and my sales price is $600, and I would like you to tell me, first give me the journal entry, right, which you have to do anyway, right? So I might ask for the journal entry for that. It's going to be 2, right? Because I sold inventory. Oh, on account. Okay? And I already have the inventory. When I bought the inventory, I debited inventory and credit accounts payable probably, right? And it's in that's in the inventory account, of course. And then this sale is going to be on account. I'm going to trust my customer to pay me later. And I'm selling product, right? Okay, so give me the journal entry, which is going to be really 2 entries, okay? One for the cost and one for the sale. Okay, give me the journal entry, and then what I'd like you to do is tell me what happens. What's the effect of the entry? That could be another question, or I could put them all together. What's the effect on assets, liabilities, equity, revenue, expense, and therefore net income? Tell me that. And then, what would be the effect if I failed to do it? Fail to record. Don't record any of it. Fail to record.
Are we just assuming that you paid cash for the inventory?
You're not going to record the inventory. Don't worry about it. It's already in there. So it doesn't matter. But what I probably did was I debited inventory credit accounts payable when I bought it. Now it's in the inventory account. And then that's how you almost always buy your inventory on account. Business to business, when one business buys another business. And they pay on account. They trust to pay later. You don't stand on a loading dock with a briefcase full of money, right? Or a check, either one, right? Briefcase full of cash. They trust you. And if they don't trust you to pay them, they pay them in advance, right? You're at bankruptcy or something. Okay, so that's a good question. So I would have debited inventory, credit accounts payable, and then I'd have paid the account payable, debit accounts payable, credit cash. We're not going to record all that. Okay, I'll put it all together. So all we're doing now, I told you the cost so that you could record that aspect, just that aspect. Okay? So go, guys, do it. Should take about 3 minutes, okay? I'm not kidding. Should be really fast. Okay, 4. Don't sit there and think. Write down the journal entry. How do you record a sale? On account. How do you rate the cost associated with that sale? Good. Do that first. Then start other people. Test its funding, you guys. You should have this wired by now. Is it clicking? Already done. Clicking. Write down your journal entries first. Both of them. Then use both of them for the effect. And after you know the effect, failure to record is the same thing. Failure to record, of course, it's the same thing, right? It's just going to be over and understated for this. For the effect, it's increase, decrease. Everybody got it? so I never played baseball, and I was so far behind when I went to school, but I never played baseball. Yeah. Anyway, so it's hilarious. My wife plays softball, and she can throw a softball further than I can hit from it. And I am not kidding. She'd be out in the field, I'd be trying to hit it to her, and I was like, for crying out loud, you know. And then she burned in and hurt my hand in the glove. Yeah, scary. So, this is when she was in junior high, they used to give, or maybe freshman year in high school, they used to give hamburger every time they hit a home run. She'd get 4 or 5 a day, so she'd get all of her friends hamburger. Yeah. Well, she'd be two of herself, she said. Yeah. She was a real athlete. Still is, really. Man. My poor son's not. My daughter is. Yeah, unfortunately, they're not her name. In terms of sports. What's that? Oh, I can pick strawberries. I can pick 20 pounds every half hour. That's 50 cents. Yeah. Raspberries being boysenberries. I worked in a nursery when I got old enough to get farm labor minimum wage. About an hour back then. Minimum wage was $1.25. And carried 5-gallon buckets of sand on my shoulder. And, you know, get out of greenhouses in the summertime. Work's good for you. That's why I actually think you guys are that farm labor. It's good for you. That's a good job. Also working at a fast food joint is good for you. That's how I do it. Anybody done that one? Yeah, he's laughing. Yeah, it teaches you about working and management and.
You know, I'm nasty American people are.
Yeah, that's sad too. Yeah. Okay, so let's do the journal entries. What are they? I sold an account, $600. What do you want to do, guys? Debit. I'm not hearing anybody say anything. Isn't it debit accounts receivable on account? And credit what? Sales revenue. We put the word revenue on it for now. Later we probably won't. But it's correct if you don't. So we'd have that first, and then what's the second entry we'd have? Well, we did the sales revenue. Debit accounts receivable, credit, sales revenue. Then what? No, we don't call it inventory expense. Cost of goods sold. Yeah, there you go. Yeah, we call everything else an expense, but this one, right? Pretty much. Okay, cost of goods sold. And credit what for 400? What don't I have anymore? I hear inventory. Yeah, very good. You guys have this in front of you, don't you? Okay, that's what would happen. So what I'm doing is I'm debiting an asset and I'm crediting a revenue, and then I'm debiting an expense and then I'm crediting an asset. Everybody agree? So what's the effect of doing it? What happened to accounts receivable, which is an asset? Went up by 600. What happened to sales revenue, which is a revenue? Went up by 600. Can you guys handle that? Yes. What happened to cost of goods sold, which is an expense? Went up by 400, didn't it? What happened to inventory? Credited for 400, it's an asset. It went down by 400. We're done, aren't we? What happened to liabilities? Nothing. What's the net effect on assets if it goes up by 600 and then down by 400? Net up by 200. That's what I'd want. That's the answer, right? Assets went up by 200. No effect on liabilities. What must be the case with equity? Must have gone up by the same 200 that assets went up by, right, guys? This should be on your paper sitting in front of you, okay? Revenues, I'd say, went up by 600. Expenses, I'd say, went up by 400. What happened to net income, of course? Only went up by 200. Excellent. Starting to think this way, aren't you? It's terrible. It's scary. Okay, and you're done. What caused the increase in the equity? The increase in the net income did it, didn't it? Absolutely. Okay, so if I fail to record it, if assets are too high by 200, or are going to be increased by 200, right, with the entry, what's wrong with them now? If we don't do it, understated by the 200. Everybody agree with that? Liabilities, if nothing's wrong with them, nothing's wrong with them. No effect of not doing anything, right? Okay? All right? If the equity should be 200 higher, what's wrong with it? Understated by 200, which of course is exactly the same thing as the asset side. because we didn't change liabilities. By the way, what if I gave you something to change liabilities? Then the liabilities plus the equity has to equal the assets, right? So I could have over or understated on them, right? Yeah. Okay, revenues, what do we got? It should be 600 higher, so it would be understated by 600. You guys agree with that? We're good, aren't we? Okay, and expenses should be higher by 400. What would be wrong with it? Understated by 400. What about net income then? Understated by just the 200 difference, and which is what caused the understatement of equity. And we are done. We got all the points. We know what we're doing, which I could care less about the points I care. You know what you're doing. Right? You're not going to make money off the points I give you in this class. You're going to make money off of what you know. Right? Yeah. A degree doesn't get you a good living. A degree doesn't make you successful. Knowledge does. But GPA does matter for getting your first job. There was a guy I worked with, a Dwyer Colson, CPA from Washington, who went to school at Central Washington University. Central Washington University was the first school I taught at. It was a fun place. And he had a blast when he went to school. So he graduated with the minimum GPA you could have to get a degree. And he went to work for Continental Can, an American can, an aluminum company, right? They make cans, right? Hot tanks and stuff. And he went to work as an accounting clerk for them because it was the only job he could get. He worked for a couple of years and studied for the CPA exam, learned what he didn't learn in school, right? And then as soon as he passed the CPA exam, he got a job with a CPA that actually had him typing financial statements with a manual typewriter, not electric, manual, right? You ever seen one in a museum? Anyway, and he actually did that. He did it for a year, and he says he didn't learn anything. And the guy signed him off as being a CPA now because he had a year's experience. And then he got a job with Dwyer Colson. And he became a partner after a few years because he knew what he was doing. And he learned a lot when he was there. He was a senior and I was a manager, and he was my age, you know. We were really good friends. And I taught him an amazing amount that I had learned in school and I learned at Arthur Anderson working in public accounting. And he just soaked it up, soaked it up, soaked it up. And then I left him to teach. He became a partner. And he probably makes 4 or 5 times what I do. I'm kidding. So my point is, you have to learn it now? Of course not. You can do it later if you want. Sounds like a hard way to go, doesn't it, to you? Oh, by the way, I was making about half again what he was making double. Well, I was teaching one day. And we were the same age. That sucks. He didn't like that very well. Right? Okay. So, but he did like learning stuff. So could you do this? Absolutely. So what else would you guys like to do today, seeing as we have a quiz next time?
On the practice quiz, 5A, we are not going to do depreciation.
Oh, depreciation. Oh, yeah, we talked about it real briefly. That was one of the things when I wrote the quiz that I thought I really need to go over with you guys. I'm glad you asked about that. Depreciation would be a really, really good idea to know how to do. In fact, I made it a little more complicated on their quiz, I think. And I think I did on yours. I'm not sure. Either that or it was on your test. I can't remember which one. But, or both, maybe. I don't know. I have no memory, luckily. Okay, luckily, so that you'll learn how to do it. So let's say that I'll make up one. Let's say I buy a truck. I like trucks. Piece of equipment. Or a building, doesn't matter, okay? And I buy it for $10,000. It's used, real used. Okay, $10,000. And I think I think when I get done with it at the end of its life, it's going to have a salvage value. We didn't do this yet, did we? Salvage or residual value. Let's say it's going to be $1,000. What that means is I think I'm going to sell it for $1,000 at the end of its life. So as I depreciate how much I used up, all I'm going to depreciate is $9,000, which is depreciable value. Okay? That makes sense? Here's the cost, right? Here's how much I'm going to sell it for at the end. Here's how much I'm going to depreciate because I want to still be on my books at $1,000. And my accounting records at $1,000 when I sell it for $1,000 at the end. I'm taking out my crystal ball and guessing how long it's going to last and guessing how much I'm going to sell it for at the end. Everybody got it? Or at least how long I'm going to use it. And let's say that we think it's going to have a 4-year life. okay? And let's say we're going to use straight line depreciation. And what straight line means is I depreciate exactly the same amount every month, every year, every day, I guess, right? Same amount every year. Got it? Good? Okay. And that's sort of what problem was, something like that. Yeah, one of the questions. All right, cool. So, what would you do? If I gave you the 10,000 and I gave you the 1, immediately calculate the 9. Suppose so? Then what do you want to do to get straight line? How much depreciation each year?
5,000.
Yeah, take the $9,000, divide it by 4 years, and what do you get? 2,250. So let's depreciate this thing for its life, huh? I won't make you do that, I'll just have you do 1 year, right? Oh, by the way, what if I bought the asset, say, 6 months into the year and I only held it for 6 months? How much would my depreciation be? Not 2,250, what would it be if I only had it 6 months? 1,125, I just take half of it. Got it? So if I gave you half year, or what if it was 1 month? I divide 12 into 2,250, whatever that is, that'd be my depreciation expense. Is this waiting on you guys? No, because you understand what you're doing, huh? What does depreciation expense represent? I am using up the utility value of this piece of equipment, this truck. Truck's not going away. It's still there. So I leave the truck account alone, right? I'm going to leave the $10,000 in trucks. In fact, when I bought the truck, 1 second, when I bought the truck, how would I record it? Debit what and credit what? Let's say I bought it for cash. Debit trucks or equipment or whatever you want to call it, right? For the whole $10,000, not for the 9, and credit cash. What if I gave them 40% down? How would I change that? What if I gave them 40% down? I debit trucks 10,000, credit cash 4,000 in credit, notes payable, probably not accounts payable because they're not going to trust you. They're going to have to sign a note, right? Notes payable or contract payable for 6. This is too easy to believe. I think that's on the quiz too, isn't it? That was on the first quiz, wasn't it? I just do the same thing over and over here. Why do people think accounting's hard? There's nothing to this. Okay, anyway, so we already did that then, huh? Okay, so question factor, did I answer it? Did I go long enough you didn't
I was
remember?
going to say, to do that, you debit depreciation expense and credit accumulated depreciation.
Yes, and a really good question would be what? What is depreciation expense? What kind of account? Expense? It's an expense. No. Depreciation expense.
Oh, expense.
What's an account with the word expense in it like that? It's an expense, right? Okay, yeah. Depreciation expense is an expense. Where does it go? On the income statement, on your expenses. It's the cost of using up that asset. And you're trying to generate revenue with it, right? Using your delivery truck or whatever it is. And what's accumulated depreciation? Wait, contract asset. It represents the portion of the equipment you use up.
You would list it like directly under the equipment cost.
Yeah, when you do the balance sheet, I'm probably going to have you do sometime before we're done. What do? You list equipment or buildings or whatever it is, both. And then you list accumulated depreciation right after that with brackets around it, and then show the net, the two of them. The book value, yeah, net or book value. Absolutely, you got it. Book value means in the books. You know, like you call the books. Used to be a book. Put an H in it, right? And when they had finance, they had it all bound up so that you didn't lose them, I guess. They always had to know assets first and liabilities and equity in a sheet of paper. They have columns for debits, credits, taxes. All you in the computer, right? And in the computer, it's positive, negative electrical charges. In your computer type thing, is still true? It is. Yeah, it doesn't know what it is. It doesn't care. It doesn't care about that, right? It's negative, positive charges. Okay, so that's how much I know. Yeah, you're done. So to answer your question, it's a great question. That's great. Just out there, everybody. Yeah.
Okay, so still regarding that transaction, at the bottom of this practice quiz is relating to the debit, which the debit was equipment. So is that when we need to run?
Well, when would you record depreciation? Is that what you're going to ask me?
What?
When would you record the depreciation?
Well, on part M, it says, do we need to enter relating to the debit? So the debit,
Yeah, that was the
That might be
interest,
both.
that's the interest on the debt.
Same thing, and
I love it. That's great. You two sitting there together having a great day. You're halfway caught up with her now, that's great, I like it. Okay, yeah, the debt, yeah, okay.
Only because the debit and the equipment.
Yeah, and the equipment, they're both debits, yeah. Okay, so let's depreciate this thing, huh, guys? So those are good questions, okay? So let's depreciate this thing. It's going to be $2,250 per year, and let's assume we bought it the first day of the year. And this is the last day of the year. So we bought it January 1st, this is now December 31st, so we got a whole year. What are you going to do? Debit what? Depreciation expense. Because all expenses are increased with a what? Debit. Why? Because equity's on the right. Yeah. And you increase equity with a credit, reduce it with a debit, and as I increase my expenses, I'm reducing net income, which is reducing equity. Right, guys? You're sick of me saying that, aren't you? Everybody knows this. Okay. And then credit what for 2,250? Accumulated depreciation. And again, why don't I credit trucks? The truck's not going away. That's the idea. I want to be able to tell people on my balance sheet how much I spent for the trucks, right? For all my equipment and buildings. And then I want to show them accumulated depreciation, which reflects how much I used up. It's not changing market value, you guys. Have you ever bought a new car yet? Some of you have, a few of you have. You will, right? It's crazy, but people do. My wife loves new cars. You can just wait a year and buy it for much, much less. And have an almost new car for, 2/3 the money or something. But no. She wants it brand new. That's the smell of that new car, the feel of it. The no deals ever had her car, or I don't know, whatever. Okay, so I love her, so she has the car. Anyway, I always have to use them, you know why? I get hers. Yeah, I get hand-me-downs. And I drive around out there and that's her. Anyway, so, but I look cute in it, right? That's why I bought it for her. She looks so cute in it. That's what she told me. Yeah, so anyway. So what we want to show people is how much we paid for the asset, that asset, equipment, and building, and how much we've used up is utility value. But what happens to market value right after you buy something new? The bottom falls out. We're not going to reflect market value here. We're not even trying to. In fact, some things increase in market value, right? We're not showing fair value in the financial statements for land, building, and equipment. We don't know what the fair value really is anyway. When's the only time you know what the fair value is? When you sell, yeah. Now, we will show some things in the financial statements of fair value. Trading securities, we call it, which is investments in other companies' stock, and their bonds, which is their debt. So if I have investments in other companies, and they're publicly traded, right, on Wall Street, say, right, what do we know about those companies? We know every day what their stock's worth. So those will adjust the fair value, where there's a market for it, okay? But most things we leave at historical cost. Right? You read about that. We leave it and you'll read some more in later chapters, a little bit about theory. Okay? 5, I think it is. Okay? We leave them at historical cost, even though that really doesn't represent its value very well after any time goes by at all. But at least it's measurable, right? We know what it is. You can use it, at least to some extent, to make business decisions. Financial statements don't really tell you what the business is worth. Don't even come close. If I knew exactly what the business was worth, I wouldn't tell you. I would use that information to decide which stocks to buy in the stock market, and I would capture all the wealth in the world over time. Because I'd be the only person in the world who knows what the stock's really worth. Because what it's really worth is what it's going to adjust to over time, right? So I know which stocks are going to go up and which ones are going to go down, and I can place bets on that, and I would capture all the wealth in the world. Nobody knew that. Okay, nobody's got that figured out. What are we going to use financial statements for? Try to guess what the value of things are. Try to estimate. Not what you thought, huh? Okay, so we'll talk about that more as we go along, of course. Okay, so yeah, that's the journal entry, huh? So let's do a T accounts here for this. And let's look at what we have in equipment. Well, equipment has the 10,000 in it, right? Let's look at what we have in accumulated depreciation, which is how much? 2,250? Got it? That's at the end of the first year. What's the carrying value or book value of this, or net value of the asset? 10 less 2,250. Everybody agree to that? Okay. And then what would we have in depreciation expense? Whatever that is. What is that? 7,750. What would we have in depreciation expense? We'd have the debit of 2,250. Right? But what are we going to do at the end of the year? What are we going to do at the end of the year? Close the books. Start the new year. Which one of these three accounts gets closed? To retained earnings. Just the expense. Excellent. So this goes away. This is way beyond where we're at, guys. But that happens. And then we start over for the income statement, don't we? So we're going to show $2,250 on the income statement as expense. Right, guys? Okay. And we're going to leave this in there because you're not going to, by the way, when you start a new year, do you undepreciate your assets? There's something new. You just started a new year? No. So it's still going to be an asset that's depreciated $2,250. Everybody got the idea? Right? And then we're going to depreciate more the next year. So at the end of the next year, what would you do? This is year one. What would you do at the end of year two? Exactly the same entry. Debit depreciation expense. The same account, right? Credit accumulated depreciation. Everybody got it? For $2,250. Oh. So now what do I have? In depreciation expense, $2,250. Everybody see it? In accumulated depreciation, $2,250. How much do I now have in accumulated depreciation? $4,500 because I have used up 2 years. What's my remaining book value, carrying value? It's $10,000 less $4,500. It's $5,500. Everybody got it? Then guess what you're going to do? You're going to close the books. And that's going to make this depreciation expense be nothing, isn't it? Right? Everybody agree? That's the closing entry that second year. What are you going to do the third year, gang? Exactly the same thing, aren't you? That's a sale. Exactly the same thing, right? You're going to do it every year for the 4 years, aren't you? You're going to do it exactly the same thing for the 4 years. Everybody agree? Till its life is ended. Then you're going to stop. Don't keep depreciating. It'll become a negative asset, I guess, because your accumulated depreciation would be more than the equipment, wouldn't it? So you don't want to do that. Okay, so if I do that 2 more times, I'll put 2250 in here, and then I'll put 2250 in again, right, guys? And of course, the debit would be going into depreciation expense and getting close to retained earnings. Each time I'm taking 2,250 out of retained earnings as I use this up, because I'm reducing my income by that, aren't I? So the whole $9,000 comes out of retained earnings over time, right? Because you used it up. Everybody got it? Of course, you're generating revenues with it too. Hopefully your revenues are more than your expenses. It's called net income. Okay, so now what would we have in this account? 9,000. And what's the remaining book value? 1,000, which is the salvage value, and if I sell it for 1,000, I have no gain or loss. If I sell it for more than 1,000, I'll have a gain. If I sell it for less, I'll have a loss. Okay? Oh, sure. You want to do it? You can do it.
That's what I was asking about the balance sheet entry. Like, I know you said you add the accumulated depreciation, but how does it balance on the sheet?
You're going to show the equipment for building, right? Less accumulated depreciation. Accumulated depreciation is growing. So the
so you just list the book value?
Yeah, you're going to show both. You'll show the cost less the book value. So here's what's happening. Let's take these entries. Let's take this journal entry and show what happens to assets, liabilities, equity, revenue, expense, huh? Debit depreciation expense, 2,250, and credit accumulated depreciation, 2,250. What does that do, guys? That's a great question. Okay, it was debit depreciation expense, right, guys? 2,250. And it's credit accumulated depreciation. His question is, well, how does the balance sheet balance when you do that? And that's a great question. What happens? What's a debit do to depreciation expense? You got it. That increased, right? That's that one. Okay. And this one, a credit to accumulated depreciation makes that contra account larger, but what does it do to assets? A credit to the assets total. As that contra account goes up, assets go down, right, guys? Everybody see that? So I'd have, she's exactly right, 2,500 less. Okay? What are the liabilities? Nothing. There's no liability in the entry. What must be the case with equity? Less by 2,500. See why I like you to analyze this thing? Look at it. Okay, so because those two have to be the same, right? All right, so what happened to revenues? Nothing, there's no revenue in the entry. What happened to net income then? Down by 2,500 for the depreciation, right? Which is what caused the equity to go down. Did that answer your question? And then the next year, of course, you close, right? The expense, and then you start over. But what's going to happen is you'll have more in expense, less net income, right? Again, and you'll have, again, less equity. So now it'll be less equity by, I said 2,500, way to go, Keith. By 2,250, and now it'll be 4,500. You got the idea? Is that clear? Yeah. Good. Nice insight. Nice insight. So, how are we doing? Oh, you want to know about what would happen if we got rid of it. That's okay. If something occurs to you, it's the time to do it. If you're working on something and you go, oh, I wonder how that works, figure it out. Why not? Okay? Because it's fresh and you don't have to get reoriented. So let's do that. Let's say that we have the asset now. We're going to do this anyway. Let's say I have equipment on my books. $10,000. And let's say I have accumulated depreciation. And let's say I've just done 3 years. And I decide to sell it after 3 years instead of waiting the whole 4. Okay? Could you do that if you want? Of course, you can sell an asset whenever you feel like it. You thought the life was going to be 4, but you ended up only keeping it 3. Okay. So you'll probably sell it for more than 1,000 now, right? Because it's only 3 years old instead of 4. Okay, so what we did each year was we put 2,250 in here, and we did it 3 times. Everybody agree with that? You staying with me? That's the first 3 years depreciation in there. So how much would we have in there? 6,750. Okay? So if you put this on the balance sheet, you would show equipment for 10,000. You'd show accumulated depreciation. Of course, you'd write it out pretty than that. And again, you can abbreviate on my quizzes and tests as long as I can tell what it is, right? When you get an Allen Dex 212 class, be careful. Ask him what he wants. Okay? All right. Become an accounting major. So we got 6750 here. That one's a debit. This one's a credit, right? Okay? And so what do we have? Net book value, right? Net carrying value, net equipment, how much? 3,250. All right, let's do this 3 different ways. Sales price for the piece of equipment when I sell it, let's sell it for cash. Let's say it's $4,000. Let's say it's $3,000. Okay? 3 different scenarios. This is A, B, C. Sales price is $3,250. Okay? What do you think we'd do? Do this first. Yeah. Cash. I sold it for cash. What do you want to do? Let's debit cash. What'd you get rid of? An asset named equipment. Excellent, you guys, or trucks, whatever you called it, right? How much should we take out of equipment? 10. You don't have it anymore. Take the whole thing out, for heaven's sakes, right? Sold it. So credit it for 10. Okay? What else do we have on this piece of equipment, though? Now we have 0 in equipment, and we have a credit balance and accumulated depreciation. Everybody see that? Better get rid of the accumulated depreciation if you get rid of the equipment, don't you think? Let's debit it. For 6,750. But you know what? The difference between 10,000 and 6,750 was 3,250, wasn't it? I sold something that's on my books at 3,250 for 4,000. What happened to me? I have a gain. We don't call it revenue and expense now because I'm not in business to do this. This is not the normal course of business for me. I'm not in business to buy and sell this truck. I'm delivering product. I'm UPS maybe. I'm delivering product with the trucks. So when I sell the truck, it's a gain or loss because it's peripheral, incidental to my business, right? I'm using the truck as a piece of equipment. Now, if I'm Ford Motor Company and selling trucks, then it's sales and cost of goods sold. Okay? All right. So what we'll do then is we'll have a gain on this. Do you think a gain is going to be a debit or a credit? To make this journal entry balance, I need a credit, right? So it's got to be a credit. But why else does it need to be a credit? What is a gain similar to? What is the gain? 750? Yeah, 3,250 or 4,000. It's similar to revenue. Yeah. It goes on the income statement, similar to revenue, increasing income. We'll do that in a later chapter, real soon, actually. Okay, so there's the first one. Let's do 3,000. What do you think 3,000 would look like? Do that. How much cash did you get? How much equipment did you get rid of? 10,000. This is too easy. How much accumulated depreciation do you need to retire because you don't have the truck anymore? 6,750. Do I have a gain or a loss if I sold an asset that's on my books at 3,250 and I sold it for 3,000? I have a loss. You think a loss is going to be a debit or credit? What's happening to your wealth? Your equity. It's going down with a loss. Gain increased your equity. It's a credit, just like revenues, right? A loss decreases your equity, right? Decreases your retained earnings. Loss has got to be a debit. Plus, I have to have a loss to make the journal entry balance anyway. Aren't those debits and credits fun? Really, when you think about it, it makes your life so much easier. 250 was a loss, was it? Ta-da. Okay, and now do C. This could be unbelievably easy this time. How much cash did you get? 3,000. Whoops, 3,250. 3,250. How much accumulated depreciation to retire? How much equipment to get rid of off of our books because we don't have it anymore? If I don't have it, I take it off, right? Somebody else has it. How much gain or loss is there, obviously? Nothing. See that? So, I better have that equipment test. What do you think? I don't think it's there. It'll certainly be on the file. We'll go get it later. Okay? All right.
Question. What would you classify the gains and loss as? Would they just be revenue and expenses, or would you put them in separate?
No, they're separate categories. What you do in your income statement is you show revenues, less cost of goods sold is gross profit, less operating expenses, which don't include these, right? Rent expense, salary expense. And that gives me my income, right, from operations. And then below that, I show non-operating items, gains and losses, right? And a few other things. So I show gains and losses. And then after that would be net income before tax. And then I would take away the income tax, and then I get net income after tax. Unless I have extraordinary items and discontinued operations, then I have those below that. All netted tax. We get a lot to do, don't we? Yeah. But that's a great question, yeah. So they're showing in a non-operating section because it's peripheral to my operations. I want to separate what I'm doing as a business, my operating sales, less cost of goods sold, gross profit, and operating expenses, that net income. I want to show that operating income separate from the non-operating stuff, like gains and losses on disposal of equipment. There's also gains and losses on retiring debt, believe it or not. Oh, right.
What you're talking about right now does not show up on the balance.
Shows up in the income statement. All of it does. Gains are similar to revenues. They increase net income, right? Losses are similar to expenses. They decrease.
We won't have to do gains and losses tomorrow.
I don't know. I'm having to do a financial statement, so
So we won't have
if
to do
they
gains
show
and
up,
losses statements.
put the losses with the expenses, put the gains with the revenues. I don't think there are any losses or expenses like that. Yeah. I didn't write that problem. I just grabbed it. I don't think there is. Okay. All right. Good. Good. So what else you guys want to do? Did we cover everything that you didn't know how to do, maybe on that quiz at least? On homework? Let's do an unearned revenue. And if you have to go while I'm in the middle of the unearned revenue, go. Right? All right. So.
Real quick, can we just do one problem from E4-3 in the book?
Yeah. Yeah. Read it, Jim.
It says at year end, the company had earned interest revenue of $1,500. The cash being collected March 1st, 2000.
Okay. So it's E4, exercise 4, guys. What page are you on?
Page 197.
Exercise 4-4? 3-4. Exercise 3-4. Okay. Page.
Exercise 4-3.
Exercise 4-3. Okay. Sorry. Exercise 4-3. All right. And which part of it? B. Okay. Part B. And they say what?
At year end, the company had earned interest revenue of $1,500.
At year end, the company had earned interest revenue of $1,500. They haven't recorded it yet.
And the cash will be collected March 1st, 2015.
Cash will be collected next year, right? Year ends December 31st.
think October.
Oh, October 31st, okay. All right. So year end is October 31st, and there's 1,500 that they have earned but have not received yet. What would you call it if you earn it? Well, that's if somebody has a pay slip or receivable.
Yeah, right.
Although I think I'd call this one interest receivable. Right, because it's interest. We would, okay? Accounts receivable is for selling the product. Okay, it's good for service.
The requirement.
So I think it'd be interest receivable, right, because we haven't been paid. And I think it'd be interest, would you say, revenue because we earned it. So how do you increase revenues? Revenues. They increase your equity, so they gotta be credits, right? Okay, so interest revenue gets credited for how much? 1,500? And what would you debit for 1,500? Interest receivable. Does it give you any more than that, or is that just it?
That's it.
Ah, well, let's make it more complicated. Let's say that they pay you the note. Let's say it's a note receivable of $10,000. And this 1,500 is only part of the interest. They're gonna pay me the 1,500 plus another 500, so they're gonna give me $2,000 of interest when they do pay me, okay? So when they pay me March 31st, was it, of the next year? This is year 2, this is year 1. Let's say that, we reported that, right? Because this was our adjusting journal entry at year end. And let's say we have accrued no more interest. That's accruing interest, right, guys? I recorded the revenue before I got paid. Accrual. It is, isn't it? So I accrued interest. Okay, so what would we do then at March 31st when they pay me? How much are they going to pay me? No. They're going to pay me $10,000 of principal, the $10,000 note, right? I have a note receivable from them for $10,000. I loaned them the money, I debited notes receivable and credited cash for $10,000. So what I changed it on. They're going to have $10,000 on the note they're going to pay, and they're going to give me $2,000 interest, which includes that $1,500. Okay. I must have earned between October 31st and March 31st another what? 500. So tell me the entry, you guys. How much cash are they going to give me? 12,000. Yeah, you bet. It's going to be the 12,000 here. Absolutely. What are they paying me? What do I no longer have? Yeah. So what do I call the principal? The 10,000 principal. What account is it in? What? When I originally loaned them the money, you guys, what would I have done? I would have credited cash for $10,000 if I gave them cash. No receivable, sure. So where is that $10,000 right now on my balance sheet? It's in notes receivable. If they pay me, what do you want to do to notes receivable? If somebody owes me $10,000, I have notes receivable on my balance sheet. If they pay me, how much should I have in notes receivable on my balance sheet? It's kind of zero on that one, don't you think? How do you get from 10,000 debit to nothing? Credit. You guys aren't tired, are you? You guys started out tired today. Okay. I think I'm not being hard enough because you're just too relaxed. I'm kidding. That was funny. Okay, notes receivable, $10,000. Don't you think? Let's get rid of this thing. That was the original entry, so now we're getting rid of it. Well, journal entry doesn't balance. Give me a couple more credits. Interest what? Interest receivable goes away. How much is the interest receivable? At $1,500. If they pay you the interest, do they owe you the interest? No. So do you have that asset anymore? No. You got cash instead. So you debited cash, you credit the interest receivable. See, 10,000 was paying the note, 1,500 was paying last year's interest. I need 500 more, you guys. What's that? I think that's the interest between October 31st and March 31st, don't you? So that would be interest what? Seeing as I earned it this year. My fiscal year end was October 31st instead. That's interest revenue too, and we're there. Could you do an entry like that? It's pretty tough. But yeah, makes sense, doesn't it? Okay. You want to do unearned revenue? Today is the day I'm supposed to work with the principals for the 45 minutes in between. Is that right? On our little schedule. Still has your assignment schedule. Is that right? You guys go. Huh? What says both today? How could it possibly be both today? Screw that out. It's got to be one or the other. The day before. Today's Wednesday.
Yes.
Wednesday, you guys. Tomorrow is both know anything else or anything. Well, they might. You need to go. That's the wrong duck. The wrong duck. Yeah. It's not Oregon. Do you know Oregon's mascot is Disney's Donald Duck? And you know why? They don't pay Disney for it. Disney would never let a school use it. They might have had it first. I'm not kidding. They both started using it at exactly the same time. Because Disney sued Oregon about the University of Oregon about it, and Oregon won. Nobody can determine who had it first. Oregon really wanted it to be that Disney stole it from them because they wanted royalties for all those years. For the fact that they didn't work that way. Yeah. All Disney wanted was for them to quit using it. They don't have to quit using it.
You're still recording.
Oh, well, that's important stuff. Let's stop recording. That's a good idea. Thank you. Seeing it's an hour and 15 minutes. Okay, and then thank you. And then